Good afternoon, everybody. Welcome to our Short Verticals webcast. I'm Connie Hill, sitting in for Brett while he enjoys a few more days off. He's had a nice long vacation, and I think he's going to be back here in a couple of weeks. In any case, I'm happy to be here. We're going to be able to follow up on some of the trades we did last week, but today I really want to focus on entry signals and what we need to maybe be looking for if you want to have a short vertical trade going on. What might you consider? Now, last week we talked about creating a custom template. I am curious. I know some of you went out and built one, and I'm curious how many of you did. Feel free to chat in that you said, yeah, you built one. I can do that. I'm smart. Very good. Well, I am joined in the chat today by Cameron May, friend and fellow coach. Happy that Cameron is back here with us. He'll help me answer some questions maybe I can't quite get to, or that are maybe just a little bit off topic. He will have my back there. So I hope you're following us on X. He is Cameron May CS. I'm Connie Hill CS. And we'll post educational content, things that we're noticing about stocks or news or things that could be helpful to you to know. We're going to post about them. All right, let's go through our disclosures and get into our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes only. Don't consider it a recommendation. We'll be using the Paper Money software application. It's provided for educational purposes. I think it's a fantastic tool if you're new to this strategy to do some practice trading in while you're kind of fine-tuning what rules you might be comfortable with. One thing different in short or in Paper Money is that it will not assign short options early. In the live market, that definitely can happen to you. If we have a scenario like that, I'll point it out to you if something we have is in the money. Past performance is no guarantee of future results. When we talk about probabilities, which we will do in this class, keep in mind they are theoretical in nature and never guaranteed. We put in a stop order with a execution based on a market order. Keep in mind the price is never guaranteed based on whatever the trigger is. All right, quick announcement here. Next Thursday night, so almost a full week from now, we will be having our mid-year market outlook. A lot of you are really interested in that. We have some nice guests that are going to be giving us some good kind of tidbits as far as what they're seeing going on in the marketplace that might impact us for the second half of the year, which is hard to believe we're already talking about the second half of the year. Okay, so that's going to be June 25th. You can register for that. I'm going to copy a link in over, see if that's still the same link. Yeah, I think that is. Those of you that are here live, you can use that link to register for it. It'll be simulcast with YouTube that particular day. All right, today we're going to just talk about some concepts about short verticals, and I told you we're going to focus on entry points here today. As we look at some of our trades from last week, we'll talk about trade management techniques. And I have several example trades that I'd like us to be able to have time to go through today. So that is what is on the docket. Now, some of you might be a little bit new to short put verticals and what they actually are. If you're newer to that strategy, I'm going to recommend you hit Cameron's class, Getting Started with Options. Cameron, I've forgotten which day that's on. Maybe you could type in what day and time that takes place. He goes through a series of all of the basic option strategies, lays it all out for you so you have a good feel for how the strategy works. In this class, we're going to assume you kind of know what a short put vertical and a short call vertical are as far as creating credit spreads. But, we'll talk about some of these elements. We don't expect you to be perfection yet, okay? With a put contracts, or a put spread, I should say, we're going to sell a contract. That contract of the put creates a potential obligation for us because that means the stock can be put to us at any time up until it expires. So we kind of have that in the back of our mind, but we also buy a hedge leg. And that hedge leg will allow us, but it's a right, not an obligation, to sell the underlying strike stock at the strike price anytime up until options expiration. So we've got one that obligates us, one that we potentially could use for that hedge if we needed to. Typically, it's going to create a credit for us. And so we get paid right at the beginning of the trade. Usually you get paid at the end of the trade when say you buy the stock and then you sell it. In this case, when we're selling, that credit goes right into our account. But the trade isn't finalized until it comes options expiration, or in the event, say there's an assignment, or if you want to exercise the right of your leg. It is a bullish trade. We want the thing to go up. It's kind of like we're saying, hey, we're finding an entry signal here. We're going to sell, bring in the premium, and then our expectation is that the stock is going to go up. And so the value of that spread diminishes gradually over time and with some time decay and stock price action, right? Typically, that's what we're looking for it to do. And I told you we're going to focus on entry signals here today, and we've got several different entry signals we're going to talk about. But essentially, if you've kind of have the idea of what you like to see for a stock entry point, some of those will translate right over to finding entries on short verticals. Now, typically we want stocks that are bullish. They have a bullish trend. You can also do one that is a kind of a sideways or neutral type trend. And maybe it's because the stock has maybe had a run and it's just kind of resting a little bit and goes into a sideways trend. That could be okay. We want to find stocks that are either bouncing off support. Some of you will use that acronym of a CAHOLD, a close above the high of the low day, as something you're wanting to see on the chart. You might be looking for a breakout of resistance, right? And we have this little picture show you a couple of examples here. This red candle here is definitely kind of a follow-through candle. Maybe these two candles here were the breakout above resistance. Down here, we've got our little bullish bounce, or even if it was down here, that would be a little bullish bounce. So we'll talk about some of those entries. And I want to also add on there, which ones are more aggressive and which ones are more conservative, which ones give us a lot of evidence that the stock's moving that direction and maybe which ones aren't. Okay, let's head over to the Thinkorswim platform. And before we get into our current trades, I want to go through our trades that we did last week because there's not a ton to go over. Okay, so we'll kind of move that out of the way. We put on 3 short verticals last week and taught you how to create those custom templates. And I didn't see if anybody actually did those. I think there are a few of you who told me in other classes that you had created those templates. So I'm just curious if any of you that are still in here have done that as well. Feel free to let me know in the chat. The first trade we're going to talk about is Micron. Microns have been having some good news this week and continues to just fly up, now over $1,100. But when we were looking at it last week, it looked like it was maybe there was a support level here. It looked like it was maybe bouncing off our blue 10-period moving average and kind of giving us either a bounce look, or some of you might have said, hey, that kind of looks like a close above the high of the low day. And it was that as well. So that's the day we got into the trade. So that was Thursday. This was Friday. This was Monday, had a nice gap up. And then Tuesday, it ran up just a little bit, hit our target order that we had in mind. We said, hey, if we get this percent, we're out of Dodge. I don't remember exactly what the percent was that we went on this one. It could have been 70%, it could have been 60. We varied it. But if we come over here to our account statement, we brought in a credit. This is the mistake one. This is the one we're going with here. We brought in 330 on that one. And we said, hey, we would be happy to buy it back at, looks like we had a 99 cents. We said if it gets 70% of our max gain, we can see here in the history, if we got 70%, we would be happy to get out. That was supposed to be a limit order around 99 cents. And it looks like it didn't charge us quite that much to buy it back, only charged us 80 cents, so that's kind of nice. We kept a little bit more profit in our account than we already said we were happy to do. Had 3 contracts on there, so that was a pretty decent gain for that trade. Now, our other 2 trades, I'm going to say, are continuing to work, and we're going to allow them to continue to work. We had First Solar. On First Solar, we collected 365. It hasn't gone down in value, and that's what we ideally want, is for it to go down in value. Right now, it's at 430. And we're down, looks like maybe about 17%. Let's look at the chart. Because the question is, well, should we still be in the trade or should we be out? Okay. Let's kind of see what First Solar was doing. It had a nice run up, a little bit of a pullback. We got in on this one when it looked like it was bouncing off our 30-day moving average. Yeah, the 10-day was starting to come down here a little bit. It kind of popped up here the next day, but the next days it's just kind of waffled around here. Now, I put a line in here where our short strike price is. So our short strike is sitting there at 250. And so we just want the stock still above 250. It's at 257 right now. We would love for it to stay there, stay above there. It could come down to our short strike price. It could even possibly go a little bit lower. But ideally, we'd like it to bounce up. If it bounces up, it'll get it to our profit target more quickly, and we would be able to take advantage of the time decay. Now, one thing to note here, implied volatility sometimes factors into these trades. All right, on it, looks like implied volatility has kind of dropped a little, so that actually helps our trade a little bit, right? Because it means that the premium is shrinking a little bit, the premium that's due to implied volatility. And so that would be nice, but quite honestly, it hasn't moved that much, okay, since we got in the trade. So are we worried about the trade? No, we're just going to let it work. We have our profit target in there. We also have a stop loss based on the triggers of where we didn't want to see it go. Now, the other trade we had here is GM. On GM, oh, look, I put the line in there. I didn't give us any of the other data. Oh, there it is. It appears. On this one, we had the 77.50.80 strike price. So here is our line right there at 80, which is our short leg. Currently, the price of the stock is a little bit below that by 6 cents. Okay, so for 6 cents, it's in the money. That's fine, right? We're not going to panic. It actually has been staying kind of above that 80 area. I mean, it ran up for a couple days, pulled back, but it didn't go much lower than that. And so, again, we're just going to let it work. We're not going to panic. There's no reason to think that it's a broken support or something like that. If we had a technical breakdown, then we would consider getting out. Haven't really seen that, so we're just going to let it work. These are trades of patience. All right, so we do have to all be patient with that strategy. All right. Let's see, what was Speaking Truth saying here? Oh, you're talking to Cam. Your wife is planning on learning options in the near future. Yep, she'll be hitting up Cameron's classes. Absolutely, you would want to do that. Have her learn how to stocks work first and then move into options. Absolutely. Okay, that's the status of our trade. So hit profit quickly, still working, nothing to be overly concerned about. Okay, let's take a look at, we'll go back to GM here real quick. Let's see, we're down on it about 26%. So nothing really catastrophic there. Okay, we're going to let them work. Let's head over to trades that could be some possible new setups for us today to use as example trades. First one we're going to look at here is Cisco. Now, when we're talking about Cisco, what kind of an entry do you see it potentially having here? When you look at Cisco, what kind of an entry, like if you look at the chart, are you seeing an entry or are you not seeing an entry? I'm going to say this particular one is maybe doesn't have as much evidence that the stock is going up as some of the other ones we might look at. It does have this pullback here. Yesterday was the low day. Yesterday's high was 119.66. Looks like we're a little bit above that now. Earlier when we were sizing up the trade, it wasn't quite there. And so some people actually do like to get in when the stock is out at support. Maybe there's not a big bounce, maybe there's not totally a hold or something like that. Sometimes they might choose to get in, especially if that support level's been holding the stock. And this one, you can see it's holding really nicely around that 113. Okay, so this one we're going to say is a candidate. Ricebird says, maybe it's a bull flag. It does definitely have the pullback off the high. What we really don't have is a nice steep trend unless we were maybe looking at a weekly chart. If we looked at a weekly chart here, then I think you're absolutely right there. We'd say, well, look at this long flagpole. And then maybe it's just kind of going sideways as a sideways flag. So looking at it a weekly kind of gives you a little bit more of that impression. Okay. Let's do this. Let's head over to the trade tab. Let's head over to Cisco. Generally, traders are looking for 20 to 40 days worth of time that they like to sell. One thing I was going to look here real quick is let's go to a little bit further out. And I want you to say, do you think that implied volatility is at a higher range or a lower range than it's been, say, in the last year? It got down as low here as about a 0.21, 0.20, 0.23. Got up as high here as 0.52. Right now it's sitting at about 38. So it's a little bit higher, but I wouldn't say nearly as extreme here. And sometimes traders will look at the implied volatility levels to see, hey, if I can't decide if I want to do a vertical that's a credit spread or a debit spread, sometimes they might look at that. And if it's really high, that might tilt them to go the direction of doing a selling type strategy. So on Cisco, let's see. Let's go out 29 days. Cisco does a ton of trading. It's already traded 15 million. I think as I was looking at this, let me think here. Some of these that were in the verticals here, the open interest was a little bit light. Now the price of the stock is adjusted somewhat. I was initially thinking we'd do the July 17s, and I think for simplicity's purposes, we'll just go out to or July 17 rather, go the monthlies where we know at about any of those strike prices. We don't need 120 anymore. Let's go 30. That we might be able to find something that we're interested in selling here. So rules of open interest. Now, the one that stands out to me here is that 115 and then buying the 110 as a hedge. Look how tight these spreads are. $1.41 by $1.49, 8 cents. Ooh, awesome. 273 by 284, 11 cents. We love it. And so when you see this kind of liquidity in the volume, and then you're maybe even looking at monthly contracts, a lot of time they have more volume and open interest. And so those spreads tend to be a little bit tighter. So these are, I'm going to say, delicious to look at. All right. Let's go ahead. Let's put in our sell vertical. And let's jump it around here a little bit. Let's take it to say 135. I know that's a little bit over the midpoint. We may or may not leave it there, but $1.35, is this credit good enough for you? Does it meet a reward percent that you're comfortable with? Let's run the numbers. Let's put in here, let's kind of move that over. $5 minus 135 is going to be our max theoretical loss. We're not going to make any more than 135 per contract. Okay, that's going to be the limit we would make. I want to kind of look at here This column is the probability of expiring out of the money. So it's about 64% right now. Usually something we would call higher probability is something over 60. So kind of meets that criteria fairly nicely there as well. So if we take our $5 minus $1.35, that gives us 365. So 365 is our max theoretical loss. We're willing to risk more typically in these trades than what we have to gain. But the reason that a trader might do so is because that higher probability of success. Okay. So on this one, let's see if the juice is worth the squeeze. $1.35 divided by 3, that was 65. It's about 63%, or not 63, 36. Being a little dyslexic there, 36%. So some traders may have a minimum threshold that they want to get. Some of them might say, well, depending on how many days I'm selling, I want to get a percent for at least each day, say 29%, maybe targeting here. So it's a little better than that 29%. So I would say many traders would find this desirable. But if you have a lower threshold, you would go with your numbers. If you say, or a higher threshold, if you say, I want 40%, then you would probably pass on this trade. Or you might sell more aggressively, maybe sell the 120, buy the 115 as your hedge, start out here a little bit in the money. Okay. How many contracts can we do here? I hope you guys just have this formula down, that you know what to do for position sizing. In our class here, we're willing to risk $200 or $2,000 per trade. We're going to divide that by 365. We can do 5 contracts. So we are going to put on 5 contracts here. We're going to put in a profit target, meaning if we get a certain percent of this 135, we'll be happy to get out. Okay, so let's put in our opposite order here. And some of you are going to have different amounts. If you get, 50% of it, you're happy. If you get 60%, 70, 80, whatever, 90%. Something that's fairly common, and we've seen this in our classes, something that's fairly common is some people will target many times at 50%, some a little bit higher, 60, 70, sometimes 80%. Most of you, when I've quizzed you, don't go above 80%. 80% is kind of like, I'll be happy. I'll be really happy if I get 80%. It's hard to get that many times. So here, let's for this first trade, let's say we're happy at 70%. So take $1.35 times that by what would be left. If we've got 70%, then only 30% is left. We'll go buy this back for 40 cents. And we'd be happy. We'd be happy campers, would move on our way, just like that Micron trade did for us last week. Went up and hit its profit target. And that was nice because afterwards it pulled back a little bit. So it was nice that it hit that target that day. And we're going to hit confirm and send. Kind of review it, make sure you didn't fat finger the quantity, make sure you're not getting 55, right? We're going to put this in our short verticals grouping here. That'll make it a little bit easier for us to track. All right, we got filled at that 135 price. All right. Looks like we might be having a question. Oh, to speak truth, saying maybe a not very well defined head and shoulders pattern in Cisco. Kind of like maybe the shoulder here, the head up here, maybe a reversal pattern of a shoulder here. I can see that. The key here is if this stock breaks down below the support line on that potential bearish reversal pattern, that would be the entry, right? And you can see so far it's holding it strong, but that would be considered the neckline. Well, maybe we could consider actually up here the neckline. That's just support. But if I were going to draw in the neckline, it would probably be about like this. So it's maybe in the area of the neckline right now. Okay. All right. That's trade number 1 with the least amount, kind of a low amount of seen the stock go the direction we need it to, although it's continuing to climb here. So, and it is above our high of the low day. All right, next one up, let's look at this one. And as you look at this chart, I want you to tell me again, type in what entry signal that your eyes see. All right. Your eyes might see a little differently than my eyes. Come back here a little bit. So Royal Caribbean had been trending down. Maybe it had an inverse head and shoulders pattern, meaning a shoulder here, head here, second shoulder there. In this case, saying, all right, it's a bullish reversal pattern. And its neckline would be maybe something like in the neighborhood of maybe something like that. And it definitely popped through that earlier, little pullback, testing maybe support, giving us a little bounce up here today. So some traders might like that as an entry. Now, yesterday's candle went up really kind of high. And so it is not higher than that low candle. It's in the region of it, but currently it's not quite there. So maybe it has maybe a little bit of evidence that it's going that way. Some of you might look at that as a flag breakout, right? If I drew a flag pattern here and I said, here's the flag pull, here's the flag consolidation. Oh, that didn't want to stay. I hate it when that happens. Let's try it again. Oh, I think it's because I'm too tall up there. Not that I'm too tall. I'm hitting the top there. All right, see, and then we have our little flag pattern. Some of you might see that as breaking out of a flag. So some of you might have picked up on that. Good. Some might use that as an entry signal. Implied volatility here has been dropping off because the stock's been going up. When a stock's going up, usually people aren't so scared and so timid about it. They're not concerned, right? There's not a lot of fear, so there's probably not a lot of put buying. So we're seeing the implied volatility in the case of this stock kind of pull back a little bit. And it's been a little jumpy. All right, let's go to our trade tab. This also has weekly options, which are nice. It doesn't trade nearly the volume that Cisco does, right? 1.4 million shares today compared to the 15. But it still is plenty liquid, especially as we look at these options expiring in July, the monthly ones. Lots of open interest. So typically, sellers are going to want to sell a 30-something or a 40-something or sometimes a 20-something delta. And we do have our choice here, 43, 33, 25. Depending on how aggressive or conservative you like to be. Somebody that's more conservative might shoot for that 25 delta. Or if we had super high implied volatility and all the premiums were a little bit higher, sometimes you can get your desired percent return even though you go out of the money a little bit. I don't think it's going to happen on this one. Somebody being a little more aggressive might go with a 43 delta. Okay. We are just going to go right smack in the middle there. We're going to go with that 33 delta. 300 strike price. We're going to sell. We'll buy the 290. And notice it's a $10 widespread. Did I get the right strike price here? 300. I did it wrong. I did a buy instead of a sell. Let's do this one more time. Sell vertical. There we go. Red and the right number. I'm going to lock in our 295 there. So again, it's a $10 widespread. What do we have to gain? No more than 295 a contract. What do we have to lose? 10 minus 295. So we're looking there at what, $7.05. So we have to know, does it meet our minimum threshold for a percent return? Let's pop it in here. Oh, let's pop on Mr. Calculator. There we go. So we're going to take 295, divide that by 705. That's what we get when we subtract the 10 from 295. That's a 41% return. So that actually is even just a smidge higher than our first Cisco trade. Okay, we're going to put it on. We're going to say that meets our criteria. We're happy with it. Again, if you wanted different strike prices to be more conservative or more aggressive, you certainly could. But a 41% return, that's nice. Oh, that's very nice. Oh, I shouldn't have moved our calculator out of the way. We need to see how many contracts we can do. So again, we're willing to risk $2,000 per trade, which is about 1% of our account. So starting with that $200,000 account, but just risking the 1%. And on this, we need to divide it by 705, because that would be our theoretical loss per contract. In this case, we can just do 2 contracts. Sometimes you're going to be tempted to round it up and go, oh, that's so close to 3. If you want to be really careful on your position sizing, we're just going to stick with the 2 here. And again, we are going to put in a opposite order, and we're going to put in a target to get out of this trade. Okay, and we're going to calculate it manually. We went with 70% last time. Some of you I know are 50% fans. Some of you are 60% fans and 80% fans. On this one, why don't we go with the 60%? Okay, so we'll say 295. If we have 60%, then 40% is left. So multiply that by 0.4 and would say, okay, gets down to $1.18, get us out of the trade. Let's take that profit. We're not going to try to squeeze everything out of it. Let's just take it, 118, and get out of the trade. You know, very seldom do people feel bad when locking in a profit on a trade. Sometimes we're like, oh, I could have got more. You know, I could have got 70 or 75%. But sometimes it's like, I don't know if it's worth the risk to try to get that much more when you've got your biggest chunk. Okay, so we're going with get your biggest chunk. We're going to send this in. We're going to put it in our short verticals bucket. All right, looks like we got filled on that nicely. Okay, let's look at one more here. And yeah, let's do this one. We're going to go a little bit different on this one. We're going to go to target. Hey, on target, do you see an entry signal? If so, what signal what are your eyes seeing? I drew some of it out. Looks like we have a nice flagpole here. Pop, pop, pop. But if I were to draw in the flag, some of you would go, I don't think that's broken out of the flag pattern yet. Let's wait for it to break out. And you could do that if you wanted to. The entry signal we're going to use here is we're looking at this candle formation. Who knows what candle formation this candle is with today's candle with it? So we've got just a nice bearish candle, and then we have a bullish candle that's kind of in the middle of the body of our bearish candle. Okay. If you happen to know what kind of candlestick that pattern is, you would recognize, oh, that's a harami. It's a nice Japanese name, right? Harami in Japanese means pregnant. And so it's just kind of a visual thing where you have the body of the person, here's mommy, and then out poking here is the little baby. Okay, so this is our pregnancy candle, our harami. It can be a reversal candle pattern as well. So we've got kind of a couple things going on. So somebody that maybe is a little bit more aggressive and is saying, I like the harami there, might go ahead with the trade. Somebody more conservative might say, let's see if it breaks out of the flag pattern tomorrow, right? That would be a little bit more evidence that the stock is moving that direction. So we've had some trades with, you know, entry signals you're probably comfortable with, like Cajal's, and then we're having this one here, maybe not as adapt, and maybe not, I don't want to use that word, but it's just a little bit more aggressive. It's not a lot of evidence that the stock's going up. Okay, so yeah, that Virgil, you're talking about this candle here definitely was a big bearish candle. It didn't really eclipse the previous day's candle, so we can't call it an engulfing candle, but I would say it's a stronger candle than engulfing because the body ended up clear down here. Yeah, very good. Now on this one, if you were to wait for tomorrow and wait for a flag breakout, you could use the height of the flagpole to set a target. If you wanted to use the technicals. In our class, we've just been using numbers. Okay, so on here, let's go to target. 2.2 trade did today, has some weeklies. They're not really, I mean, this one is a great number here, 847. That's a great number of contracts, but some of these others are just kind of sparse. So again, we're just going to go to the Julys. July has lots and lots of open interest. We're liking it. Now again, multiple choices. We've got a 45 delta. We don't have a 30-something delta. We jump down to a 28 delta. Okay, so for spread purposes of trying to find something in that range that we like, and nothing is really that perfect there. However, if we look at, we could look at this 45. Now, it is not a higher probability yet. Okay, if the stock continues to move up, that probability will change. Right now, it's sitting at 51%. So if somebody wanted to be 60s minimum or had a rule that you say it's got to be 60 plus, you would go for the 28 delta here. That would be the 125 strike. But this one here only has a little bit of leeway, right? 73 cents on the 130. But let's price these out, okay? If I say sell vertical on this first one, and then let's make this a blast all, then we'll queue up the other one right next to it. We'll go the 125 strike as the short leg, the 120 as the long leg. We've got 186 or 101, okay? I'm gonna put on here that this is trade A, right up here. This is trade B. We're gonna do an unofficial survey without creating a survey in YouTube, okay? And I'm gonna go with what the class wants. If class wants A, we'll go for A. If class wants B, we'll go for B, okay? Kind of ballparking and looking at what the return is here. In your mind, you can probably go, okay, $4 divided by $1 is about a 25% return. So if that doesn't meet your minimum threshold, then you might say, I'm not going to do that one. On this, if we have 5 minus 186, then 314 is our max theoretical loss. So we'd be risking that to make $1.86. What kind of a percent is that? Okay, let's let us know. What was that? 186 divided by 3. What was that? 3. Now I forgot what my number was there. I shouldn't have cleared it out. What, 314? Is that right? 314? I think it was 314. It's about a 59. So we're in the ballpark. If I'm off on that other number just a little bit. Yeah. So that would be a 60% return. So if some, and I know people who say, you know, I would prefer a bigger reward because then if I'm wrong, I know I have a higher probability of being wrong, but if I know if I'm wrong, I did that wrong. Let's do this one more time. Let me check my numbers here. 314, and I think I plugged in something different than 314. I guess it was only a couple pennies off. I think I did 340. We'll just do it. We'll just do it perfectly here. 186. Divide that by 1.86 or 1. 186 divided by 3.14. There we go. Okay, yeah, it is that 59%. Okay, so I told you I'd go with what the majority was. Majority voted B. Thank you, Virgil, for helping me with my math there. The value of pi, 3.14. Perfect, Jenny. Yeah. Okay. Most of you are like, let's do the more conservative trade. So we will. Now, if 101 is what we have to gain here, maybe we could try to get a lot of that. What if we try to get, say, like 75% of that? And then maybe buy back at, say, 25 cents or something. Those are just kind of ballpark numbers. Let's do our position sizing here now that we know which trade we're going to go with. So we're going to go with $2,000 divided by 3.99, right? 501. Let's see, that is not quite right. $2,000 divided by our max theoretical loss of about $4, right? Risking $4 to make $1. I'm hitting the wrong key. That's what the problem is. 2,000 divided by 400. Okay, 5 contracts. We can do 5 contracts, so we will. And we'll match this up. And let's go buy it back. If we can get it back for a quarter, then that will be about a 75% gain, okay? So in this one, we're going to go more conservative, but we're going to try to get more out of the gain, right? Going for, say, 75% versus 70 or 65. Going to make that a good till canceled. Not going to put a stop loss on these. Typically with a hedge position, many traders don't like to even put in a stop, although we've talked about that last week with the template. And off it goes. We're going to put it in our short verticals bucket. All right. We've got 3 fresh trades here that we just got filled on. So we have Target, we have Royal Caribbean, and we have Cisco. Looks like all of them are down a little bit, which is not that surprising. That can happen, right? When you initially put in the trade and you're like, oh, dang, that spread is there. Yeah, it's the spread a lot of times. That's all right. Are any questions on any of those trades that we reviewed here today, new trades or the ones that we reviewed? Andy says, Ken Rose would say, not enough per day on the 125, 120. Yes, because the max there is about 25%. And so for some traders, it would not meet their threshold. So if the one was too low and the other one was too high, somebody might pass on the trade altogether, right? On Target. They might say, it's not meeting my criteria, so they might pass on it. And that is just fine. There are plenty of fish in the sea. All right. Appreciate you being here. Appreciate your questions and kind of clarifications and catching me on my math, making sure it's 3.14, like pi. I like that. So we're gonna follow these. And if you're trying to get good at this strategy, try doing some practice trades. That's my challenge to you, is gonna say, do in the next week, whether it's one of these example trades or a different one, try to do 2 practice trades in your paper money account, okay, that you can learn from. If you choose one of these, you might have questions that come up that we can talk about in our session. And that's always nice to be able to do that. Well, Cameron, I appreciate your help here today. I do want to, as we wrap up, encourage you, if you haven't already, I don't know what you're waiting for, to follow our Trader Talks channel. Tells you what's going on. You can see what's going on today. Looks like these are our different playlists going on right now. After our class, we're going to have New to Investing. Scott Thompson's leading that discussion. For those people, and actually a lot of you that come to some of our other webcasts love attending these webcasts, even though they're designed for beginner traders. You're getting a lot of information out of them. And so Scott's class will be up here No, I take that back. Do you know what? I'm pointing at the wrong one. It's actually trading with ThinkScript, okay, is going to be the next one up here. I moved over too far. All right, I can read. All right, Cameron, thanks for your help today. Each one of you, appreciate you being here. We'll follow up on those trades next Thursday. We'll see you then. Bye-bye.